Balance sheet. Dear students, today let us learn about balance sheet. What is balance sheet? Why it is prepared? How it is prepared? Various assets and liabilities that appear in the balance sheet and the form of balance sheet. In view of the fact that the assets and liabilities change from day to day as a result of business transactions, the trader must necessarily feel anxious to find out what his true financial position is at the end of each trading period. In the first place, he would like to know whether the net profit as is disclosed by the profit and loss account is correctly arrived at. For if so, his capital at the end of the period must necessarily increase by that amount. He is equally anxious to see for himself as to how such capital is made up, that is, what the component assets and liabilities of the business are. In order, therefore, to obtain this information, at the end of the trading period, he has to set out his several assets and liabilities as at that date in the shape of an statement, and this statement is called the balance sheet. A balance sheet may therefore be defined as a statement prepared with a view to measure the exact financial position of a business on a certain fixed date. It is prepared from the trial balance after all the balances on the nominal accounts are transferred to the trading and profit and loss account and the corresponding accounts in the ledger are closed. The balances now left in the trial balance and the remaining open in the ledger represent either personal accounts or real accounts. In other words, they represent either assets or liabilities existing at the date of the financial close. All such assets and liabilities are set out in the balance sheet in a classified form. On the right hand side are shown the various assets or possessions of the business, and on the left hand side the various liabilities, that is, the amounts owing by the business. The excess of assets over liabilities represent the capital of the owner. This figure of capital must tally with the closing balance of capital account in the ledger after the net profit or loss has been transferred thereto. Various assets and liabilities that appear in the balance sheet. Assets. A trader's property and possessions as also the debts owing to him are known as assets. The debts owing by a trader to other persons are known as liabilities. Capital is the excess of trader's assets over his liabilities. Deficiency is the excess of a trader's liabilities over his assets. Fixed assets are those assets which are acquired and intended to be retained permanently for the purpose of carrying on business, such as land, buildings, plant and machinery, etc. Floating assets or circulating assets are such assets as are acquired either for the purpose of resale or held temporarily in course of business for their subsequent conversion into money, such as stock in trade, book debts, bills receivable, cash at bank, cash in hand, etc. The question as to whether a particular asset is a fixed or a floating asset would depend on the nature of the business. Thus, machinery would be a fixed asset in a manufacturing concern, whereas it would be a floating asset in a machinery dealer. Land and buildings would be a fixed asset to a trader or a manufacturer who has acquired the same for a trade purpose. But the same would be a floating asset to a land and buildings company whose business is to buy and sell landed estates. Office furniture in any concern would be its fixed asset, while furniture belonging to a dealer in furniture would be a floating asset. Horses would be the floating asset of a horse dealer but would be the fixed assets of an agricultural concern. The main standpoint for distinguishing a fixed asset from a floating asset is whether it has been acquired for resale or for the purpose of permanent equipment. Liquid assets. Liquid assets are those which are represented by cash or those that can easily be converted into money, such as cash in hand, cash at bank, gilted securities, and bills receivable. Wasting assets are such assets as are consumed through being worked, such as mines, quarries, cemeteries, etc. The term wasting assets is also used to denote such assets as are liable to depreciate on account of their use in the business, such as plant and machinery. It is also used in connection with some assets reduces, whose value reduces coextensively with lapse of time, such as lease, patents, etc. Fictitious assets are such assets as are not represented by any tangible possession or property, such as preliminary expenses, expenses prepaid, debit balance of profit and loss account, and even goodwill. Fixed capital of a business consists of its fixed assets. Floating or circulating capital of a business represented by its floating assets. Working capital means the capital available for the working of a business after its fixed assets have been acquired. Capital expenditure. When an amount has been expended and the expenditure results in acquisition of an asset or in an addition to the value of an existing asset, such an expenditure is styled capital expenditure and will take its place in the balance sheet. Revenue expenditure. All ordinary expenses incurred in the course of running a business, such as salaries, wages, printing, stationery, advertisement, rent, postages, telegrams, etc., as well as any expenses incurred in keeping the existing assets in proper repairs and maintaining them in their original state of efficiency, and which do not result in an addition to the value of an existing asset, which would be classified as revenue expenditure and would find its place in the revenue account, that is the profit and loss account. Deferred revenue expenditure. Any expenditure which is primarily of a revenue nature, but the benefit derived from which are not exhausted during the currency of the period, would be carried forward and treated as an asset to the extent of the unexpired benefit. Such carrying forward is no doubt permissible, provided it is not continued for such a length of time so as to affect the profits of the years which it cannot be considered to have benefited. The most frequently occurring examples of deferred revenue expenditure are preliminary expenses, alterations to machinery or plant, special repairs, and advertising. Balance sheet and profit and loss account are interdependent. As the balance of profit and loss account is transferred to the capital account and as the closing balance on capital account is shown in the balance sheet, it is clear that the balance sheet shows the position inclusive of the profit or loss made during that period. The chief object of every balance sheet should be to disclose all information necessary to enable one to form a true estimate of the financial position of the business as a going concern. As the true financial position of any undertaking is reflected by its assets and liabilities, as indicated by the balance sheet prepared on any one particular date, it follows that these assets and liabilities should be mostly carefully valued for this purpose. Any overvaluation of assets or undervaluation of or omission of liabilities would result in unduly inflating the profits. Similarly, any undervaluation or omission of an asset or overvaluation of liabilities would tend to unnecessarily decrease the profits. Even the balance of profit and loss account included in the balance sheet should be correctly arrived at. It must be further understood that inasmuch as the figure of net profit or net loss as shown by the profit and loss account ultimately finds its place in the balance sheet, both these statements of financial accounts are closely interdependent on each other. It follows, therefore, that if any item of expense or income is omitted or is over or understated, it would not only affect the accuracy of the net profit or loss, but will equally affect the correctness of the balance sheet. For a correct preparation of the true financial condition of a business, it is equally necessary to see that all assets and liabilities are fully and accurately set out. It is further important to see that these assets and liabilities are properly grouped and classified under appropriate headings, and that no material fact is suppressed or is presented in a manner as would create a false impression as to the state of affairs in the mind of anyone reading the balance sheet. A balance sheet is not drawn up with a view to show what the capital of the concern would be worth if the assets were realized and the liabilities paid off, but rather to show how the capital stands invested at the end of each financial period. The values in the balance sheet are therefore not breakup values but are ascertained on the assumption that the business is not to be wound up in the near future but will continue to run its normal course. As fixed assets are acquired not for resale but by way of permanent equipment to serve as a medium to enable the business being earned on, they should not be valued on the basis of the price they would realize if sold. The true basis of valuation of such assets would be their original cost, their probable life, that is, the estimated period of usefulness to the business, and the likely breakup value. The difference between the original cost and the probable breakup value would represent the loss suffered by the business on account of the use of such assets and would have therefore to be equitably distributed over the estimated life of such assets. In other words, each fixed asset would be shown in the balance sheet at its original cost minus such accumulated depreciation or deterioration in value it may have undergone up to the date of the balance sheet. Floating assets, on the other hand, are held for a resale with a view to profit or for immediate conversion into cash and are therefore valued at the cost or the current market price, whichever is lower at the date of the balance sheet. Both the fixed and floating assets should be valued on the basis of going concern. Form of balance sheet. There is no hard and fast rule as to the order in which the assets and liabilities of a sole trader or proprietorship firm should be stated in the balance sheet. One method is to place the most easily realizable asset first and then follow it up by assets which are less easily realizable so that the asset most difficult for realization will be shown last. As against this order of assets, the liabilities will be shown in the order in which they are payable, the most pressing liability being placed on the top and first. Form of balance sheet. Balance sheet has a right side and left side. On the left side, it contains liabilities such as bills payable, creditors for loans, creditors on open accounts, outstanding liabilities for expenses, and capital. On the right side, asset side, cash in office, cash at bank, investment, sundry debtors less reserve for doubtful debts, bills receivable, stock in trade, loose tools less depreciation, fixtures and fittings less depreciation, plant and machinery less depreciation, factory buildings less depreciation, goodwill. By totaling, the balance sheet should tally and it will match by the principle of double entry system of accounting. The other method is to marshal the assets and liabilities in exactly the reverse order to the above, so that the fixed and permanent assets and liabilities appear first and will be followed by floating assets and liabilities. The latter arrangement now seems to be followed by almost all concerns except banks and financial houses, which prefer to show the liquid and floating assets first and follow them up with the fixed assets. It should be noted that while preparing the balance sheet of a limited company, it is in this order of assets and liabilities that is required to be rigidly observed by the prescribed form of balance sheet under the Companies Act. In the next lecture, we will discuss as to how to calculate the commission to manager on profits.